Just going to wait a couple of minutes and give everyone an opportunity to join. We'll get going in 1 or 2 minutes. Alrighty. Welcome everybody to the BBB Pre-Internship Advice Webinar. My name is Ryan McCann and I'm a partner of the firm and also your host for today. I would like to now welcome our panellists. Firstly, our senior accountants, Sherry, Kelvin, Eno and Anthony. These guys will be your primary consultants and contacts if you engage and when you engage with BBB. Next, we have our advisors, Mick, Lincoln and Greg, who will each be joining us later on for a chat. Great to see you all. Just a bit of housekeeping before we start. We do have the Q&A box up and going today, so we encourage anyone who has any questions to please enter them into the box. We have our team on hand to answer everything as we go and progress through the session. So let's get things started. We're going to start with a bit of audience participation. Can I pose a question to you? What would you rather have, $1 million or 1 cent that doubles in value each day for 30 days? We'll have an opportunity to put your answer and your response in. So the question again, $1 million today or 1 cent that doubles in value each day for 30 days. We'll keep this open for about 10 seconds. Responses are coming in, which is good. The results are so we have 36% of people who grabbed the $1 million and ran. And I'm sure they're sitting there very happy with their $1 million in hand until they understand that the other 64% are now 4.5 times richer. The table on the screen shows the power of compounding returns. If we look at the left-hand column, we've got small increases through the first 8 days until we earn our first dollar. And then we continue slowly up until the first 15 days. But it's not until the second half of the month that we start to see the big gains. And in particular, those highlighted sections in the last 3 days where it really starts to kick ahead. What we need to understand though, it was the hard work in the first 15 days that made the end result possible. And this is similar to your career. What can we do now to set yourself up for future success? And this is going to be our theme for today's session. So why BBB partners? We have over 40 years of experience providing accounting and financial advice to medical professionals. We understand doctors and we understand the issues that you face and will confront at all stages of your career. Now, whether that's setting up your salary packaging as an intern or setting up private practice as a consultant down the track. No problem, we're here to help, we've got you covered. We provide continued education to increase your financial literacy You will receive personalised advice specific to your circumstances. You get the support of a team that will help you adapt and avoid costly mistakes when life changes or unexpected events occur. And research supports having an advisor leads to better financial outcomes and mental well-being. So how does the process work? Let's start at the top. The aim of the game is to achieve financial freedom. Now, what financial freedom is different to each person. But for me, it's setting myself up financially so I can live the lifestyle I choose to live. I could choose to continue to work. I could choose to retire. I could play golf, go on a holiday, do some volunteer work. My choice what I want to do. But to support this lifestyle, I do need an income. And that's not an income I get from working. That's a passive income that I derive from assets, which means I need to grow my assets. And I do this over the course of my career for various strategies that will involve property, cash, shares, and superannuation. But before I can consider any of this, I need to make sure the foundations are in place first. And there's 5 key areas of focus here. The first is cash flow. Don't spend more than you earn, or in short, have a savings plan. Debt management. We want to get rid of all our credit card debts or any other personal loans that we may have. And if we are going to borrow to buy an asset, make sure it's structured correctly. Risk management. Do I have a plan B if things go wrong? Estate planning. Do I have a will in place or powers of attorney? And tax management, which is a big one. The reality is once we start earning income, we're going to be paying tax. But what strategies can we put in place to legally reduce this as much as we can? A couple things that we'll discuss later. Tax deductions and salary packaging are going to be high on your priority list. So just to recap, financial freedom is the goal. We need a plan to get there, and we start now by building the foundations. I hope that's clear and it all makes sense. So if you've got any feedback or questions on how it works, throw them in the chat box. But now's time to get the experts in for a chat. So first, I want to welcome Michael Curran from our finance team. How are you, Mick?
Good, Ryan. How are you doing?
I'm going pretty well.
Good, good.
How busy are you?
Oh, very, very, very busy at the moment, Ryan, being honest with you, because since the COVID restrictions have lifted, the property market has really become active again, because clients can basically physically go in and view a property. This coupled with the historically low interest rates is really giving clients the confidence to go in and buy property at the moment. For example, a 5-year fixed rate interest rate now is at 2.99%. So what basically is saying there is that the Reserve Bank of Australia is saying that over the next 5 years, this is where the interest rates are going to be. So if you wanted a bit of confidence in your budgeting purposes, it's an ideal time to purchase a property.
Yeah, fantastic. And buying a house is going to be one of the biggest financial decisions that people make. Can you explain where you fit into the house purchase process?
Yeah, well, I'm a mortgage advisor at BBB Partners, and I basically advise clients in taking out finance and literally arrange it for you. I would actually love to say that there's one lender out there that we can all use, but unfortunately I can't, because each bank have their own unique policies and procedures. So really, depending on your individual circumstances, this will dictate which bank we will actually run with.
Fantastic. And what stage should someone come in and see you in the process when they're thinking about buying a house?
As early as possible, Ryan, especially if you're actively looking at properties. I sort of find that 9 out of 10 clients will buy a property unexpectedly. They weren't expecting to buy a property, so they'll come into me and say, listen, I want to get an approval in place, but I'm not going to buy for another 6 months. Normally 6 days later, they come back to say that they've actually found a property. So I think it's so early in the piece to actually have your approval in place. We also don't encourage any clients to go to an auction without a pre-approval. It's so important to have a pre-approval in place, because with all the policy changes since COVID, it's really, really important. And believe it or not, the process at the moment it takes about 2 to 4 weeks for an approval to be put in place. So our process, for example, would be to meet the client via Zoom or or face-to-face if that allows. We complete what we call a client analysis. So here we basically capture all the personal details of the client, the employment, salary, the asset and liability position, have they got a HECS debt, what's their living expenses like? And we get all that information, and we can actually calculate their borrowing capacity from that. So at a fairly early stage, we can advise our clients how much they can actually borrow. And this, along with the cash that they're going to contribute, we can actually tell them what's their maximum purchase price. We then basically apply for the loan, and once the loan approval is in place, this approval will last for up to 3 months. Now, this doesn't mean you have to go out and buy a property within 3 months. You could be 15 or 18 months waiting to buy a property. I think the longest client that I had was about 2 years it took for them to buy a property. But every 3 months, we need to get the approval updated. So by getting the approval updated, we need to provide additional pay slips and also bank statements, just to provide the bank that the savings are still there.
No, fantastic. Now, obviously, anyone can go to a bank and apply for a loan. Why should we use a professional to assist with the process?
Just bear with me. Sorry, I just want to get the slide here. Sorry about that. Yeah, Ryan, with ourselves at BBB Partners, we've got access to all lenders. So when I mean all lenders, I mean all the mainstream banks. We're not actually tied to one particular bank. So for example, if you're looking for a 95% finance, we've got 3 lenders that we can actually use. If you're looking for a 90% finance, you're probably looking at about 7 or 8 that we can choose from. As we're a specialist medical firm, we actually understand your working environment. So your pay slips do become a challenge for a lot of banks because there's salary packaging, there's overtime, there's rotations, there's locum work. So we really simplify the process for you in the sense that when we're submitting an application to a bank, we're actually submitting it to an actual specialist medical section of the actual bank. So this basically means a smoother process. We also asked a lot of questions as regards your future needs. For example, with this property that you're purchasing now, is it going to become an investment property in the future? Because your first property is not your dream house, so it could be the stepping stone to your next property or part of a wealth creation strategy. So if it is going to become an investment property in the future, we try and structure your loan to maximize your tax deductible debt. So with that, we're in close contact with your accountant just to make sure that the structure is set up correctly.
Yeah, no, all makes sense, Michael. And so say I'm a first home buyer and I've found a property for $650,000. Can you talk us through what deposit I'd need to save to be able to go for that purchase?
No problem. With a purchase of $650,000, that's a fairly average purchase for a first-time buyer. So what would happen is that if it's an established property and the purchase price is less than $600,000, there's actually no stamp duty applicable. If the purchase price is between $600,000 and $750,000, stamp duty is calculated on a tiered basis. So in this situation here, we've got a purchase price of $650,000. The acquisition cost, which includes stamp duty, which in this case would be about $12,000. Your solicitor's costs and some small government fees would bring the total up to $15,000. So in total, you're looking at $665,000. Your loan at 95% of the purchase price is $617,500, which means that your cash contribution will be $47,500. Now, this cash contribution can come via savings, obviously. A lot of first-time buyers are getting gifts from parents to help with the cash contribution. If it's a brand new property, for example, you could look at maybe with the first homeowners grant. For Victoria, it's in the metro, you'll get $10,000 for the first homeowners grant, and for regional, you'll get actually up to $20,000. So those kind of grants will alleviate the cash contribution also.
Very good. And we see interest rates publicised on billboards and newspapers and on the TV, and obviously they're very important to keep repayments down. But is interest rates the only consideration we should be making?
No, I keep saying to clients that the interest rate is very important. Absolutely, there's no doubt about that. But the loan structure is just as important. We basically try and set a goal for all our clients for the next 5 to 10 years. So for example, you can get fixed rates at 1.99%, reduced stamp duty for first-time buyers. As I said before, under 600,000, there's no stamp duty. In between 600 and 750, you're looking at it's on a tiered basis. But I think point 3 here, the lender's mortgage insurance, this is so important for medicos, okay, because it's a huge bonus for you guys. In the example, if a non-medical had purchased that property, so borrowed 617,000, they would have had to pay 27,000 in lender's mortgage insurance. With all medicos, because of your occupation, all the mainstream banks will actually waive that insurance. So it's a huge bonus and a huge incentive for a property purchase. A mortgage offset account is also very, very important. We always try to set up our clients with a mortgage offset account because this minimizes the amount of interest the bank can actually charge you. And if the property is going to become an investment property in the future, this offset account will actually become your savings tool for your next purchase. So any cash that you've got, you keep building in this offset account and will become your deposit for your next purchase.
Great. Well, thanks for the update, Mick, with regards to the market and all the offers that are there available to medical professionals. Have you got one last key takeaway that you can provide?
Well, just in your first slide there, Ryan, you'd mentioned financial freedom. To get to that financial freedom, we sort of like to think that we can give our clients financial peace of mind on the way to have all their loans structured correctly. And I also think as well with property purchases, think long term. The days are gone where you could sort of turn a property over within 2 or 3 years and make 50 or 100,000. It's a long-term investment now. So if you think long term, you'll do very well out of it.
Fantastic. Well, thanks, Mick. Thanks for your time.
Thanks, guys. Thank you.
Very good. The next guest I'd like to welcome to the floor is Lincoln from our Financial Planning Division. How are you, Lincoln?
Good. Yourself, Ryan?
Yeah, not too bad. I thought it was important to get you on today just to explain how the BBB financial planning process works, and probably start with, if we can just ask you what it means to get advice, and then how does the process work?
Perfect. Thank you. So firstly, welcome to everyone and thanks for tuning in today. Now, Ryan, to answer your question, so what it means to get advice, it's different for everyone because as you have a look on the screen, financial freedom, as Ryan mentioned, looks different for everyone. Ryan's is potentially choice of work when he gets older. So he has a choice of whether he comes into work or he doesn't. A lot of other people will be potentially buying a holiday house or taking an annual trip overseas. So part of the advice process is, or the first part is initially working out what those goals and objectives are and what you value most in life. From there on, we sort of step down the rungs, and as we can see down the bottom, we set in place a foundation for yourself just to make sure that it's all working and set in place a structured plan. Now, how that works is in regards to the implementation is, or the process, if you'd like, is we hold that initial meeting. Now, that can be as casual as just catching up over a coffee and having a chat about what you value most in life and where you see yourself in 1, 2, 5, 10 years time, or longer term, what that looks like for retirement and sort of what you want to achieve in life. After that meeting, we go away and we do our information gathering or data analysis, put together, if you'd like, some strategies to help you get from where you are to where you want to be. And we come back and we talk with you about those strategies and what it looks like. The last thing we want to do is implement strategies that will affect your day-to-day life. And what I mean by that is placing additional stress on yourselves as clients. We don't want you to have sleepless nights. We want our role to be more of a take away that stress from yourselves. After that, it's then we just go through the implementation and getting it all set up. And once we've done all that, it's regularly checking in with yourselves, whether it be 6 monthly or annually, to make sure that we're tracking along okay. So keeping you accountable, making sure that we're achieving those goals. Once we've achieved them, tick them off. If new goals come up, as they often do, potentially taking a fellowship year somewhere or starting a family, including those, and then reviewing your situation and adjusting it accordingly so that we're factoring those in and we're still achieving what your main value is in life.
Thanks for the explanation. And we've just heard from Michael, who told me if I want to buy a $650,000 house, I need a deposit of $47,500. Do you have any tips that you can share about how to putting a savings plan into action?
I do. So I've got 2 tips for you. So the first tip will be to set a goal and set a time frame. So I know it's a bit hard to determine where you'd like to purchase a property in potentially 5-6 years, but it's more just look around going, yep, I like that area. What does a house or apartment or a unit go for in that area? And setting yourself a rough goal and the time frame that you'd like to achieve that in. From that point of view, you can work backwards. And that's where my second tip comes into play, is to set this all up automatically or set up a savings plan automatically. So whether that's through your HR department that can direct money to a specific savings account, or whether you via your banking app have access to automatic transfers that transfer it across. So as soon as it comes in, it gets transferred across and you're not having to do anything. It's really taking it out of your hands and you get to see the pleasure of the money growing in the savings account on the side while still having money in your everyday account for your discretionary spending.
Fantastic. And our theme today focuses on acting early and the benefits of acting early. Are you able to provide an example of this for us and maybe tie it into saving that deposit for a house and how long that potentially could take?
Yeah, sure. So I'll tie it into the example Michael used before with a purchase of a property worth $650,000. So starting off with a zero amount deposit, so zero in your bank account, putting $500 away per month over a period of 7 years and generating a return of 5%, not saying that's what the bank accounts are offering at the moment, but we'll just use that for this example, is this shows that over a 7-year time frame, you can generate that $50,000. Now, you may be able to save more or less, who knows, but it's more putting in place a structured plan. Putting away that $500 a month over that 7-year time frame, your deposit, so the money that you've put away that you've earned, is $42,000. What the bank then generates in interest, or what is generated in interest, is $8,000. So by putting that aside and setting in place a structured plan, you've got $8,000 there that this money is earned with you actually potentially not doing much at all for it. And it means that you can achieve that purchase property in 7 years' time. Now, you don't have to purchase that property, but if you put that in place early on, rather than starting in 5 or 10 years' time, at that 7-year mark, you've got that ability and flexibility within your situation to purchase a home or postpone it if you need to.
Great, thanks for that. And we've talked about setting goals and regular savings deposits and having plans to achieve those goals. Do we have some tools that we can use or implement to help people manage and track their progress?
We do. So there's 2 options, as I see it, available for yourselves. First is to use Excel and use a spreadsheet, go through and analyze all your data manually, entering your transactions to determine what you're spending. That is quite time consuming. The second option is we've developed a wealth app. So it's BBB wealth app. It's on the screen now. What this wealth app does is there's a free version and a paid version, but what it collates for you is all your financial information on the one app. So you can get data feeds from your bank accounts. You can put in data feeds from your superannuation. You can put in any properties or assets that you own. So cars, if you've got any other valuables that you'd like to include in there, all these can be added in. So you get a good financial position of where you're currently situated. Part of what this app does then is with the data feeds, it has algorithms in the background that categorize your transactions for you. So this is taking away a bit more of your manual input with the Excel spreadsheet and does it within the app. And it categorizes where that money goes for you. So this is the left-hand side. So as you can see, it's got expenses, it's got incomes, credit card payments, and it categorizes where each amount goes to, and those can be adjusted for you. The benefit to yourselves as students also is in regards to an option in there, which is the logbook. So you can log your kilometers traveled for tax time. You can also store in there documents as well. So any documents or receipts can be added in. You can generate reports. It's quite a useful app just to have all your financial information in the one app if you'd like.
Yeah, great. And it's convenient on the phone, carry it with you everywhere. It's live, so it's a good tool. Final question, Lincoln, do you have a stock tip for me?
I do, but it's not a stock tip. So we recommend not to choose stocks or try and time the market. The reason behind that is, and it's based on our philosophy, is that there's a lot of information out there and a lot of academic research that just shows trying to pick stocks or time the market just doesn't work. And to lead into that a bit further is, over the last 10 years, fund managers, so people that get paid to do this on a day-to-day basis and charge people to specifically pick stocks and companies that will outperform, over a 10-year period, it's shown that 70% of those will underperform the market more often than not. So how we invest at BBB is we diversify across quite a large range of assets and markets. So assets being your Australian equities and international equities, and markets being Australian market, international market, American, China, and so forth. What we do is we also sort of put a bit of a tilt on it, and it's based on academic research, and it targets specific factors in the market that will generate a greater return over the longer time frame for you. And what that does is it means that it's not necessarily set and forget, but it's a long-term investment for you.
Thanks, Lincoln. And just carrying on our key takeaways, something that you've mentioned today, but something the audience can leave us with. Yeah,
so the key takeaways would be, I suppose, to start early, regardless of what it looks like. Starting early is probably the key. So whether it's just $20 or $50 a week or a month, just get going early, get something in place and set yourself some goals. Great.
Fantastic. It ties in with our theme. So thanks for your time today, Lincoln. Appreciate you coming on board for a chat.
Thanks for having me, Ryan.
Very good. So as we move across the foundations of our pyramid, the next area we want to focus on is risk management. So what's the plan B if things go wrong? We could have cash buffers organised, from a savings perspective, but I've got Greg Condon from our risk and insurance team to join us now, just to talk about insurances and income protection insurances and how that can play a part. Welcome, Greg.
All right, how are you?
I'm going well. Yourself?
Excellent, thank you.
Good to hear. Might start just with a hopefully a simple, straightforward question, but just really explain what income protection insurance is.
Yeah, absolutely. So income protection insurance is really just an income protection policy to pay you on income if you can't work due to illness or injury. So to put in perspective, whilst you're fit and healthy, you go to work, you earn an income, everything's great. When sickness prevents you from working, that's where income protection steps in. And I guess to tie it back to our pyramid on the screen that you can see, having that replacement income can make sure that all the plans you put in place with Michael and Lincoln can still continue to go on even if you're not able to work.
Thank you. So we know what it is. What does it cover?
So basically, if you're fit and healthy when you take out the policy, it'll cover all illnesses and all injuries, be it a broken arm, broken leg, right through to mental health type issues that can prevent you from working.
Thank you. Now, I earn $100,000 a year. If I was to make a claim, how much would I actually get paid if I had to make a claim on the policy?
Yep, so you're able to insure for up to 75% of your income. So if you're on $100,000, that means you can be paid up to $75,000 for the year. The reason for that is to give people some incentive to try and get back to work.
Very good. And so it sounds, sounds great. And the reasons why we need this cover or should be considering getting this cover, are you able to provide us an example of the cost of what the premiums are?
Sure. If you have a look at the screen, based on 26-year-old male and female, new intern income of around $78,000 a year, they could insure for up to $5,338 a month. And for typical high-quality policies that our clients typically look at, you'd be looking somewhere between $64 to $101 for a male and $90 to $146 for a female. And that range just depends on how quickly you want to get paid and some of the other optional features that are available.
Very good. I should also point out that these premiums are tax deductible, so that would reduce the cost. And if we looked at a male there, the 64 would come down to 45, and for a female, we're looking at reducing that to $63. So a bit of tax saving to go along with that. One of the benefits of taking out a policy with BBB is that we would manage the claim in the event that it needs to be done. Be able to share a recent story or recent example of how you've had to manage a claim for a young doctor?
Definitely. So having the policy is part of the challenge. So a lot of clients don't realise when they're actually eligible to claim. So that's one of the roles we have at BBB, is keeping the clients informed and actually knowing when they can claim. So one of the examples recently is one of our clients, 33-year-old anaesthetist, over on holidays in Alaska, going on a hike through the beautiful mountainside, trips over, fractured his ankle. Resulted in surgery to repair it. When he's come back home, we were doing our annual chats, having a talk through his situation, and he mentioned the fractured ankle. So identified there was a claim for him. Then we guided him through the process. The result being that he ended up getting paid $22,500 for that fractured ankle. So whilst he still had his holiday very much impacted, at least it took a bit of a bit of compensation, if you will.
Yeah, quite often when claims need to be made, it's a difficult time for a client, so it's good to have the support of the team to help them out.
Exactly. So we take a lot of that challenge out, so you don't need to know exactly what terms or conditions. You just talk to us and we do the rest as far as letting you know what we need to do to make it happen.
Yeah, thanks. And look, one of the issues I was keen to talk to you today about, Greg, is the upcoming changes in 2021 with regards to income protection insurance. Are you able to run through those for us?
Sure. So from October 21 next year, the government has mandated a whole raft of changes to happen, particularly in relation to income protection insurance. So effectively what these changes are to try and do is to make it harder for people to claim long term and make the insurance industry more sustainable. So what they're going to do is they're going to be changing some of the definitions. We don't know all the fine print yet because the insurers don't know themselves, but basically they want to encourage people to return to work so that they don't be long-term on claim. And in doing so, they're going to change some of the terms and conditions and features. So one of the features, for example, in the previous claim that had our hiker paid for his fracture, those type of features are probably going to be removed going forward from next year. So I guess the timing is, which is advantageous for the clients we're speaking to now, or the people we're speaking to now. You've got the choice if you wanted to go down the path of getting the high quality cover that can have all these extra features that can make it easier to get paid, make it so that you know what you're going to have. So one of the other features that's changing that I forgot to mention is, at the moment with policies, if you set up a policy, it's guaranteed that all the terms and conditions of that policy will stay the same right through to age 65 or 70. So you know that foundation piece is locked in. But for new policies that start after next year, every 5 years, the insurers are going to be able to start from scratch and change all the rules on the clients. So you won't actually know what you've got from one 5-year period to the next. So getting in soon will actually lock it in, and you'll know that you'll have that high quality cover going forward.
And if I was going to ask for a key takeaway, am I safe to assume it's consider these changes and acting beforehand?
Absolutely.
Very good. Well, thanks for your time, Greg. Some great insight there with regards to income protection insurance. I'll leave it there, but yeah, thanks for joining us.
Thanks, Ryan.
No problem. So we move across our foundation areas, and now we enter the area of tax management. So I'd like to welcome Sherry to the session. How are you, Sherry?
Very good, Ryan. How are you?
Not too bad. So Sherry's one of, I'm sure many of the people in the audience know Sherry through the events throughout the year. She's a senior accountant from our team. But we're going to talk about those strategies we can put in place to manage your tax affairs and hopefully provide some good outcomes. I suppose the first question for you today, Sherry, is why would we need to see a specialist accountant rather than just going to a suburban accountant down the road?
Firstly, hello everyone. Hope you guys are having a wonderful day so far, and well done for staying on with us on the webinar. And that's a really good question, Ryan. It's actually a very common question that we get asked all the time. Let me just quickly, share a story with you guys. Last year, I met a second-year psychiatry training doctor who was doing her Master of Psychiatry at Melbourne Uni. She was actually seeing her local accountant at that time, but she decided to make an appointment to see us because she felt that her local accountant didn't fully understand her affairs as a medical professional, and she wasn't getting any advice from the accountant. When she actually showed me her tax return, I saw that, she didn't claim her uni fees for her master's. She was told that, the fees were not tax deductible because she hasn't paid it, and they were put on fee help. That is actually untrue because technically you can claim your uni fees if they were put on fee help, as long as the fees were incurred in that respective year and it's justifiable that you've incurred the expense in order for you to earn your employment income. But of course, bear in mind, it's not a straight, yes, you can claim everything you put on fee help automatically. We will still need to, analyze the circumstances and decide whether the fees are actually tax deductible in your case. So quick disclaimer, this may not be applicable to you, so always speak to your tax professional about this. As you guys also, progress through your medical career, you will be spending a lot more on education costs, and obviously it's important for you to know what is deductible and what's not. So honestly speaking, you really only have two options. One is to spend all your time researching about tax deductions on the ATO website, or just send your advisor an email with the questions that you have. I personally think, it's going to be a lot easier to ask your advisor so you don't have to spend all your free time reading, tax rulings and going through ATO websites. But obviously it's ultimately your personal choice.
So use this as a resource, Sherry.
That's exactly right.
Yeah, fantastic. And what tips do you have to ensure that we don't miss any tax deductions?
Be organized. That's rule number one. Firstly, have a tax checklist. General rule of thumb, if it's work related, it will most likely be tax deductible. As your advisor, we will provide you with our tax checklist so you get a better understanding of what can be claimed. Secondly, as I said, be organized and keep good records of those expenses. Most of you will be moving around quite a bit, so having folders of stuff will be very much a big hassle. So keep things in digital copies instead. You can either scan them, take photos of them, label them on your email account, or use cloud storages like Dropbox or OneDrive, or as Lincoln mentioned earlier, our BBB Wealth app. There is a function to upload or store all your tax deductions on the app itself, which clients will think it's quite useful. The other thing is also you and your advisor can access them anytime, anywhere when necessary. And also, finally, if in doubt, keep all the receipts of your purchases. When tax time comes, that's how your advisor will be able to help you. We will run through the list of items with you and determine whether they are tax deductible or not. Obviously, over the years, you will get a better hang of it, and you will be able to filter out things that that are not tax deductible. I did have, an intern one year who told me, oh, I've got no tax deductions to claim. And obviously that's not really possible because at the very least, she would have paid for her APRA fees. Otherwise she wouldn't be able to work. But because she didn't have an invoice or receipt, we can't claim the tax deduction. So really, moral of the story, always keep records. We've been talking about tax deductions, but what does that really mean? Let me show you an example of how tax deductions will actually make a difference for you. On the left of the example, we have Dr. A, who's on salary of 90 grand with no tax deductions. And on the right, we've got Dr. B, who is also on the same salary, but with tax deductions. From the example, you can see that Dr. B, who took the effort to actually claim all the deductions, actually saved over 2 grand in tax. If you think about it, most of the Dr. A would most likely would have paid for all those expenses anyway, things like APRA, indemnity insurances, courses, conferences, or income protection, tax agent fees, etc. That just goes to show the importance of keeping good records and claiming those deductions accordingly. One question that I also always get from clients is, should I sign up for courses or buy work-related equipment so I can get to claim more tax deduction? The answer is actually no, because it's not a dollar for dollar. Remember, you're not, it doesn't mean that you spend a dollar, you get a dollar back. The tax savings that you get from your tax deductions are calculated based on your tax rate. So if you were on the 32.5% tax bracket, your tax savings will be 32.5%. That basically means, every dollar that you spend, you will receive 32.5 cents back. So my advice will be only spend on things that you need to spend. Hope this, kind of give you guys a better understanding of, why tax deductions are actually really that important.
Very good. And I've been asking all of the advisors and accountants on here today, Sherry, for a key takeaway. Do you have one with regards to the tax savings and tax deductions?
Yep. Spend your time wisely when it comes to managing your tax affairs, and always be organized. Also, if you've paid for something, make sure you claim it, because every dollar does add up.
Sure does. So that was, thanks, Sherry. That was part one of the tax management session. And there's a second part to follow shortly, where Sherry's going to run through all of the tips and I suppose strategies that you can do with regards to salary packaging. But what I'll do now is just say goodbye and thank you to our consultants who jumped on during the session. So thanks, Mick and Greg and Lincoln, for your valuable input and the key takeaways that you've been able to provide. And also for the attendees. So just remember what our theme of today's session was, is what actions can we take today to set ourselves up for later in life? So get yourselves to the starting line and book an appointment with the team. We have Sherry, Eno, Calvin and Anthony are all ready to meet up with you and have a meeting and to discuss your affairs. You can book these appointments through scanning the QR code that's on the screen in front of you now. And then once you are on board, jump over, download the app and start tracking your finances. On behalf of the entire BBB team, we wish you all the best for when you commence your careers early in the new year. Good luck, and we hope you go well. At this point, I will pass back to you, Sherry, for part two of the Tax Management Foundation session. And, you can take everyone through the hot topic, which is salary packaging. So over to you, Sherry.
Thanks, Ryan. So as Ryan said, for those who are interested to hearing about salary packaging still, you can stay on. For those who are on top of your salary packaging, you may sign off. And here's wishing you guys all the best for next year. Okay, for those who are staying on, salary packaging, what is it? How does it work? There are a few things that I would like to share with you guys about salary packaging, but before I begin, just a reminder that our medical graduates team members are still monitoring our Q&A. So if you've got questions, put them through the Q&A and we'll try to answer as many questions as possible. Remember, everyone will benefit from the questions that you ask. We also want to make this part of the webinar more interactive, so don't be shy and keep your questions coming. Remember, there's no silly questions. Okay, without further ado, let's get into it. I'm sure most of you have an idea of what salary packaging is. You have a good some sort of understanding, and have a brief idea of what you need to do. But having a brief idea alone is not enough. You actually need to set up a tailored plan for yourself before you start work next year to ensure that you're actually maximizing all your benefits. Basic stuff, salary packaging, fringe benefit provided by the hospital to the employees. It is tax-free money, but not free money. The hospital is not just giving you the money. You actually need to spend the money first and then get reimbursed. So firstly, understand, who will be involved in the salary packaging process. It will be your advisor, yourself, your hospital and the payroll department, and also finally the salary packaging company, whether it's Maxia, Smart Salary. It could also be, an internal salary packaging team at the hospital. And next, what do you think the respective roles, of these people are in the whole process? As your advisor, we will be the ones working behind the scenes to tailor a plan for you, so you get to maximize all your benefits and tax savings from salary packaging. So the tailored plan is actually really important, because remember, what works for your peers may not actually work for you. So it's important to always set up a plan before you actually start work. Then your role in this whole process is really just to give instructions to the packaging company and then submit claims so that you get reimbursed. Then the hospital and the payroll team will be the ones setting aside your pre-tax money to the salary packaging company on your behalf. And finally, the salary packaging company is the one who will be processing your claims so that you get paid. I'll quickly show you a diagram to show you how salary packaging actually really works. So, as I said, once you've spoken to an advisor, work out a plan, that's when you will then need to contact your salary packaging company and complete the form, set up an account with them and complete forms to say, what exactly that you want a salary package. Then once, salary packaging company has the instructions, then that's when they'll tell payroll department to set aside, a portion of your fortnightly salary into your salary packaging account. And finally, that's when you come into picture, you put in your claim forms and you get paid. So what are the three, I guess, main things that you can salary package? So the three main things are your $9,000 living expenses, 2650 meals entertainment, and your portable device. So under living expenses, you've got, general living costs, your credit card or loan repayments, your rent, and things like that. And under, your 2650 meals entertainment, you've got your dining out, holiday accommodation, and venue hire. And under portable device, you've got laptops, tablets, or mobile phone. So just touching this $9,000, it's important for you to remember that you should only salary package private expenses, because remember how I mentioned about tax return and tax deductions, anything work related should really be put on your tax return and not on salary packaging. So try to keep, your expenses separate so you get to, well, I guess, get the maximum benefit out of it, because I've got clients in the past who put APRA on their credit card and suddenly they don't get to double dip. So it's either salary packaging or tax return. So you have to be clear where you want to put the item. Then under, meals entertainment, you can package dining out meals, etc. So in normal times, pre-COVID, really, the rules are you need to have 2 main meals at a restaurant, no takeaways, no deliveries. But because of COVID, a lot of hospitals have actually relaxed their rules. Now they're allowing takeaways and deliveries. But in saying that, restrictions are easing a little. So always check with the hospital before you start, what are the rules there and whether you can actually do takeaways and delivery. Then obviously holiday accommodation, if you're going on a holiday, as long as the holiday is booked under your name, you get to salary package that. Okay, then portable device. If you're looking at getting a laptop, tablet, or mobile phone, most hospitals do allow you to package 1 portable device per FBT year if it's predominantly used for work, which is more than 50% for work. The tricky part, I guess, with portable device is you do need to get an approval from your head of department before you buy the item. So if you're looking at getting something, contact your packaging company, tell them, you want to package a portable device. What they'll do is they'll give you a form to complete, and what you have to do is then get it signed by your head of department. Once you've got that form signed, that's when you buy the item. Then obviously then put in your claim and get reimbursed. So that's the tricky part of portable device. So always check with the packaging company beforehand and get the forms set up. So any questions so far about salary packaging on this diagram that you guys are interested in? Guys, any interesting questions?
Sherry, there's one question. Can I use it to buy coffee?
Technically, no. As I said, 2 main meals, so no coffee. Coffee is not a main meal. But if you've got meals together with coffee, then you can do coffee. But this is not the real thing. But, MaxSafe told us, as long as you've got a meal card, you can do coffee. But as I said, if you get audited, it could be a problem. But if you don't get audited, then maybe you can get away with it. Okay. Any other question?
Sure. There's also one about whether Airbnb counts as holiday accommodation.
Airbnb?
Yeah.
Yes, you can do Airbnb. So it's similar to any hotel accommodation. As long as I said, book it in your name, you'll be able to salary package that. So make sure, even if you're traveling with other people, if you want to package those accommodation costs, always have the booking under your name. Any other questions?
Yeah, sure. We just got another one come in. Do you recommend using salary packaging for bank cards or via credit cards and claiming expenses? How do they differ?
Okay, so living expenses card, credit card and manual claim, I presume that's what the last bit meant. So I would recommend credit card repayments if as compared to the other two. With living expenses card, how it really works is you put money on the card, and when to access the money, you will need to spend the card. So if you've got no money on the card, you won't be able to spend the money. But if you've got too much on the card and you're not spending, the money gets locked away in the account. So the best way, I think, would be credit card, because with a credit card, what you're actually packaging is the credit card repayment. So as and when you need to spend, you spend. And when you want to get paid, you just have to submit your credit card statements, and that's when you get paid. And the third item, which is, general living expenses, if you are actually using receipts of items, that's when you have to be, I guess, aware of what the hospital rules are when it comes to purchases that you make on, let's say, for instance, you're buying an item, a desk for $1,100. Out of the $1,100, $100 is GST. If you're doing a manual claim using receipts, when you submit that claim, because that item has GST, you don't get refunded of the full $1,100. You only get $1,000. You lose out on the GST portion. The full $1,100 gets counted towards the cap of your $9,000. But when you get reimbursed, you actually don't get reimbursed the GST portion of the item, which means you only be reimbursed $1,000 instead of the $1,100 that you spent. But instead, if you actually use a credit card, if you bought the desk with your credit card, the $1,100, because you're salary packaging your credit card repayment instead of the desk, you actually get the full $1,100 back. So, which is why, it's a lot better to use a credit card as compared to, doing manual claims. Unless you're actually buying things or paying for things that has no GST, then that will not affect your cap. But in saying that, credit card is not for everyone. If you're disciplined, you're all good, you're good with repayments, you don't overspend, then it's okay to use a credit card. But if you're not disciplined, then I wouldn't advise going anywhere near a credit card, because the interest and late payment fees on a credit card is really expensive. Okay. Anything else?
Yeah, Sherry, got another one for you. Can the portable device be backdated as long as you get the head of department to sign the form?
Good question. So depending on which hospitals you go to, most hospitals will say no from my experience, because you do need to get an approval before you buy the item. So if you're buying it in advance, you didn't obviously get an approval. But I have seen hospitals that allow it. So depending on which hospitals you're going to. So key takeaway, always check with the hospitals that you're going to. Before you start, always understand what are the rules at the hospitals. Alternatively, make a time to come and see us. We do have a spreadsheet or on, certain things of the backdating information. So we may be able to answer that question. Any other question?
There is another one here, Sherry, again. So are there limits/conditions on what products can be salary packaged if purchased by credit card, or is the entirety of the credit card repayment able to be salary packaged?
The entire credit card repayment will be able to you'll be able to salary package the full credit card repayment. So as I mentioned, when you're using a credit card, it's just the repayment that you're salary packaging, not the item. So they don't actually look at what you're spending on. They just want to see the statements showing the repayments that you're making. So as long as you're making repayments, that's what you're packaging. So you know how I said, how you get paid is, submitting your claim forms, which is your credit card statement. So if you, let's say, set aside, $5,000 into your salary packaging account, and your credit card statements only showed $3,000 of repayments, that basically means you will only be reimbursed $3,000. You won't be reimbursed the full $5,000 until you submit your next credit card statement showing another $2,000 of repayment. That's when you get paid your $2,000. So always, I guess, time your purchases and your repayments if you want to get paid on time. But in saying that, it's better to have more in your salary packaging account as compared in this account, because when you've got more in this account, but before the end of the FBT year, which is the fringe benefits tax year of each year, 31st of March, if you say, you've got too much in your packaging account and you actually can't fully use it or you haven't fully spent it, what you can do is just tell payroll to return the money, or tell Maxia to return the money to payroll. Payroll will then just take out tax and pay you the net amount. So it's actually better to have more in this account as compared to this account. Okay, any other questions? No? Everyone's clear with this diagram, then I'll move on. Okay, cool. All right, so a few more things that I think you guys should be mindful of. All hospitals are different and the rules at each hospital changes almost every year. So always check with the hospitals before you start work so you understand how it works at your hospital, what you can claim, how fast their backdating period, how to submit claims, do they have an app or do you have to do manual claims? That will make, you know, a lot of changes on how you do things. Then the second thing is, you know, the backdating period. You must have, you know, obviously heard a lot about this, but what does it really mean? Basically, if a hospital allows backdating, you are able to claim expenses that were paid before your employment started. So that what that means is if the hospital allows 12 months backdating, this means that you can claim or package expenses that were paid in January 2020, because you're starting work in January 2021. This means you've got more options for claiming. If the hospital doesn't allow backdating, means you can only claim items or that you've paid for once you start employment. So depending on where you're going, you need to find out, you know, obviously we're in December now, you don't have much time. So if you haven't already set up your account, make sure you check with the hospital and find out what are the rules there. And number three, you know, the FBT year and the tax year, they're actually different. So FBT year, fringe benefits tax year, that's what it means. It is the year that you salary package. It runs from 1st of April till 31st of March. The tax year is the year that you lodge your tax return. It runs from 1st of July to 30th of June. So don't be confused by the year. Always draw up a timeline for yourself so you are clear about the dates and how the overlap will affect you, because you've got different rotations. You've got 5 rotations in a year. So you want to know which rotation sits where, so you know how you want to set up your salary packaging. Okay, I will also show you, I guess, a timeline diagram in the next slide so you get a better understanding of what I'm talking about. Next thing you need to know is start and stop. Do you need to do this and why? You know, and also, do you have to do this every year? Just keep this in mind at this stage, and I'll show you more about this on our next slide. Then rule rotations. What do you need to know if you have this? Is it another round of salary packaging for you? Generally, when you are getting paid by a different hospital network, there is a possibility that you get to salary package another round with them. So what you need to know is, does this apply to you and how you should plan ahead? And finally, number 6, what happens after internship? Your internship will end in January. So what happens after that? Are you staying on at the same hospital or are you moving hospitals? Again, I will go through this in more detail in our next slide. Okay, so you can see from the diagram that your first round of salary packaging runs from January to March. That's when internship starts. From 1st of April 2021 till March 2022, that is another round of salary packaging. Okay, and all right, if you look at the diagram, so from 1st of April to 31st of March, as I said, that's another round of salary packaging. But should you be packaging between 1st of April till 30th of June? Is there a need for you to stop? So our general advice usually is, you know, do your first round of packaging at between January to March, between April to June, do not package, pause it, and restart it again from 1st of July till, you know, internship ends. Generally, why we advise that is because, you know, for most of you in the first year for the 2021 tax year, you will actually only earn, you know, income from youth allowance and also half a year of salary and probably not any other investment income. And because of that, you know, your tax rate will be quite low as compared to the 2022 tax year. If you package in this period, whatever you package in this period will actually reduce your income in the 2021 tax year. If you compare it with your 2022 tax year, you're actually going to get more tax savings here as compared to here. So it makes more sense to not package in this period and pause it and restart it here. So whatever you package here actually reduces your income in this tax year. So as I mentioned earlier, the reason, again, I'll just reiterate it, is because of the tax savings difference. on here, you have half of your salary plus youth allowance. So possibly you're on a lower tax bracket of 19%. But over here, you're most likely going to be on a 32.5%, which makes more sense if you package here as compared to here. So what you actually have to do is you do need to tell your packaging company that you want to pause your salary packaging, because if you don't tell them, what they'll do is they'll assume that you will continue your salary packaging from April onwards. So somewhere in March, tell them, ring them up and say, I want to pause my salary packaging and restart it from July onwards. Then, then the next thing is, do you have a rule rotation? If you have a rule rotation, how would that affect you? So depending on where you're going, some rule rotations, when you are on your rotation, they actually allow you to salary package again through them. So always find out where you're going and what are the rules there. If they say, oh, there's another route, you are able to salary package, then obviously you have to plan your expenses accordingly. And because you get another round of the $9,000 living expenses and $2,600 of meals again. Then the next thing will be what happens after internship ends. So if you were actually moving hospitals, so remember when you are getting paid by a different hospital network, you actually get to salary package again through that hospital. So it's actually important for you to know, if let's say this year I'm at RMH, I did my internship at RMH, and year 2, I've decided to go to say Western Health. So once you've done, your first round at RMH, your second round at RMH, then you internship ends here. Then when you start at Western Health, that's another round of packaging at Western Health. So what you have to do is, tell your packaging company again, you've already started your second round of salary packaging from 1st of July. You want to finish your salary packaging by internship ends. So which means you've only got July to Jan to do your $9,000. So that is really important for you to take note, because if you don't tell them, they'll assume that you'll be there till March. But if you've got plans to change hospitals, always tell them in advance that you will stop in Jan, so they work out how much they have to set aside for you in that period. Then from February onwards, that's another round of $9,000. And by knowing what's going to happen at that hospital, you'll be able to plan ahead to see what you want to package in that 2 months. Remember, FBT year ends in March, which means you've only got 2 months here to do your maximum of $9,000. So hospitals, if they have got backdating, then you've got no issue because there are plenty of options for you to salary package. But if the hospital actually doesn't have backdating rules, that basically means you have to spend $9,000 in that 2 months. So if that's the case, you kind of have to plan ahead and say, is that even possible? Of course, I'm not saying, go spend so you get to package that $9,000. So you always, similar to the tax deductions, don't spend it if you don't have to, but if you've already spent the money, you want to package it. So because remember, salary packaging and tax deductions work very similarly. The tax savings that you're getting is based on your income tax rate. So there's no point just forcing yourself to spend just to get to the $9,000. But in saying that, with our clients, we normally say, you get your offers in October, you find out where you'll be going next year anyway in October. So come in, make a time and see us so that we can work out another plan for you and say, you are changing hospitals. Things are going to change now. We want to expedite our claim here. We want to make changes here. We want to put strategies in place so that we know what we can be packaging between February and March. Okay, I'll take some questions now. Are there any questions?
That's a good one. What if your rule rotation is during April to June?
That's a really good one. If your rule rotation was between April to June, keep packaging, because you will only be at your rule rotation once in that tax year, really. So you're not going to go back there any time. So if your rule rotation was in this period, just continue salary packaging. You don't have to pause it. Any other question? No other question?
Sorry, Sherry, one just came through then. So regarding backdating at the new hospital in year 2, are you allowed to claim expenditures which you have already packaged once during second round of salary packaging? AKA, can you double dip on the same expenses salary packaging across the 2 hospitals?
Double dip is never allowed. Okay, there's always no, the answer is always no to double dipping. It's either one or the other. If you've already packaged those expenses during your second round of salary packaging, you won't be able to do it again at the new hospital. So always plan ahead with your advisor so you know what you can package and what you can't, because hospitals like, say, Monash, for instance, they are really generous with their packaging rules. So basically, they've got no backdating restrictions. So you can package absolutely everything that you've paid for right now or 10 years ago, as long as you've kept receipts of them or have proof of expense. But when you go to hospitals like Western Health, say, they've got no backdating period. So which means you can only package items that you spend when you start work. So they're more restrictive. But in saying that, I'm not saying that you should choose Monash over Western Health. You should obviously still go to the hospital that you want to work at. But what I'm trying to get at is, always plan ahead where you're going, work out the cost that you've already spent, and plan ahead and see what you should be packaging here, and don't waste it for the next hospital, because you may need it for the next hospital you're going to, because some hospitals do 12 months. So if we're doing 12 months, so we may want to, say, keep the even older expenses for Monash, say, first, and then for the 12 months one, we can use the rent that we paid in the last 12 months or the credit card statements in the last 12 months. So when the hospital allows, no limit on backdating restriction really, then try to use your your oldest expense when it comes to claiming. So that way, that you've got extra for the rest of the hospitals. Okay, more questions?
Yeah, Sherry, we've got another one come through just in regards to the rural rotation. So should they be packaging that through that different hospital network or continue packaging that through their original hospital?
Okay, good question. Remember, when you move on your rotation, you have to find out whether it's the same hospital network or not. If it's the same hospital network, normally you'll be paid by your hospital, your normal hospital. But if you were if it was actually a different hospital network, you will be paid by the new hospital. So you have to find out whether they're on the same hospital network or not. And remember, you can only salary package when you're getting paid. So for instance, RMH and Horsham, okay? So when you're at Melbourne, Royal Melbourne, you get paid by Royal Melbourne. When you go to Horsham, you get paid by Horsham. So if you're not working at Royal Melbourne, you don't get paid there. You don't get to salary package. So you need to know where you're going and, well, who will pay you to work out what you'll be packaging during that time. Okay, any other questions?
Oh, it's going to be a bit of a long one. So I heard you can use credit card to purchase things that are salary packageable and also things that are tax deductible. And in order to not double dip, you can submit your credit card repayment statement and manually cross out all the tax deductible purchases and then submit the receipts for those tax deductible purchases for tax return to claim. Is this true? And does this work for living expenses versus meals and entertainment?
Okay, well, answer the first part first. Yes, if you have lots of time and you're bothered to do it, then be my guest. So obviously when you're submitting your credit card statements to the packaging company, you can actually tell them that you only want to package X dollar amount out of the, let's say you've got $9,000 on it. And if it's 5,000 was tax deductible items, 4,000 was, private expenses, you can actually tell them that you only want to package the $4,000. But remember, that's a lot of work for you. You've got to go through your statements and say, this is work related, this is not, this is work related, and this is not. And most of the time, you probably don't know whether it's tax deductible until tax time anyway. So my advice would be try to keep things separate. Put your packaging items or all your private items on your credit card. When it comes to tax deductible items, you can use your debit card or, a separate credit card for that. Then the second question with the meals and living expenses, same thing. How should I put it? Because you're right, with meals and entertainment, you are claiming using the invoices that you get from the restaurants. And when it comes to claiming, the packaging company don't actually look at a credit card statement for that. So if you were spending, 15 grand on the credit card for salary packaging, then your meals were only about, say 2 grand. Then you're quite comfortably over the 9 grand of living expenses. So I'll just show you this diagram so you get what I mean. Okay. All right. So remember the caps that we have here. So 9 grand living expenses, 2650 meals. So if you spend more, I guess, on the credit card, let's say 15 grand, then you're comfortably over the 9 grand. So even if you're using the same credit card for your meals, then that wouldn't be a problem. But if you're only spending 9 grand on the credit card and you want to package that 9 grand, and part of that 9 grand is, 2 grand of your meals, then technically you are double dipping, because you've got 7 grand of living expenses and 2 grand of meal. But because you're packaging 2 grand of meal using receipts, plus you're doing 9 grand of credit card repayments, that is actually double dipping. So, and that's actually, well, I wouldn't say illegal, but that's not the right thing to do. If you get audited by the packaging company, they may pick you up and you will need to return the money that you've received. Okay, so try to keep things really separate unless you know that your expenses are going to be way more than that $9,000. Touching on that, meals and entertainment can be quite difficult, when it comes to manual claims. You have to find out from the hospitals whether they actually allow you to do manual claims. Certain amounts that some hospitals got with their rules are, if you spend above, below a certain amount, you can do manual claims. Once you spend over a certain amount, you actually have to do, whether it's a meals card or things like that. So always check with the hospital what are the rules there. Okay. Any other questions?
I guess to add up to using the credit cards to pay for the tax deductible stuff, I guess it's be more organized. You can split them, but some of those credit cards comes with frequent flyer points, and we know that everyone loves frequent flyer points, I guess. So if you love those points, then you can still pay for those with the credit cards. Just make sure you highlight them or cross them out so you just avoid double dipping.
That's exactly right. Fair enough. Any other questions?
Happy for you to keep moving on, Cherry.
Okay, dokes. All right, let me just quickly see. So I think I've almost covered everything, unless you guys have any other questions. No other questions?
Oh, Sherry, there actually is one. Just regarding how does salary packaging affect your HECS help debt, and how beneficial is it to actually salary package in terms of tax savings?
Okay, that's a good question. I mean, obviously salary packaging, as I said, works similarly like a tax deduction. When you're packaging, you get tax-free money, so you don't pay tax on that portion of income. But at the same time, it does affect your help repayment. In saying that, I'll just quickly show you an example. Okay. All right. Just bear with me. I'll be 1 sec. Okay. Can you all see my screen? All good? Okay. So
Cherry,
you can't see. All right. What about now?
Yep. Okay.
Cool. You see the example?
Yep.
Okay. So when you're salary packaging, you can see here. So this is your hospital salary. That's salary packaging. That reduces your income to here, and that's what you pay tax on. But when it comes to HECS repayment, okay, HECS repayment is calculated based on HECS repayment income, not just taxable income. As your income increases, the HECS repayment percentage increases as well. So number one, remember, it's a percentage of HECS repayment income. So which means, okay, so 1 step back. So I guess HEX repayment income is taxable income plus net investment losses plus reportable fringe benefits plus reportable super and exempt foreign income. Anyway, but long story short, in your case, when you salary package, what you need to know is salary packaging is a fringe benefit, and this basically means you will have a reportable fringe benefit on your income statement. So what it means is when you salary package 11,650 through the hospitals, so the 9 grand living expense plus 2,650 meals, the reportable fringe benefit amount is actually 21,999. So what it basically means is, for someone in layman terms, really, for someone who, doesn't get to salary package, for instance, me, I need to have earned 21,999 of gross income minus tax to take home 11,650 of net pay. So, which is why the government saying, the ATO is saying, for you guys who get to salary package, although you're taking home this 11,650 tax-free money, but technically you're earning more income. So because of that, there's an add back to your income when they calculate HEX repayment. So most people will think, oh, I'll be paying HEX repayment based on this, but that's not true. You do need to add back the reportable fringe benefit of 21,999 to calculate your HEX repayment income. So if you look at that, so if we're thinking, oh, 78,000, your HEX repayment will be at 5%. But once we do the add back, it brings our income back to 100,349. So instead of the 5%, we're now down here at 7%. So that is why, your HEX repayment will increase. But in saying that, clients ask me, should I do that then? I have to pay more HEX back. Of course, the answer is yes. Why would you rather pay tax as compared to reducing your own debt? Remember, HEX is your own debt that you have to pay off at some point anyway. As compared to tax, you don't really get immediate benefits from it. So the best thing is to save tax and reduce your, even though you have to, pay more HEX back. Remember, you're not paying more HEX really, you're just paying your HEX quicker. So you can see the difference here. So how we worked out earlier. Yep. So on 100,000, you're going to be repaying 7%, which comes up to $7,000. So one thing to bear in mind is when hospital takes out tax, so you can see here, this is the hospital, they'll take out tax from your pay and then they'll pay you. Part of the tax will include tax, income tax, they'll include HEX repayment and also Medicare levy. But when they take out tax on your behalf for HEX repayment, they will take it out based on your taxable income instead of this add back income. So in every year that you salary package at the hospital, most likely you will always have a shortfall because remember what you have to pay is based on this and what the hospital is taking out is based on that. So which means there will always be a shortfall. Clients, no one likes to pay tax at the end, but as long as you manage your expectation to know that, you're actually not paying more tax, you're actually repaying your HEX debt. So you've actually saved lots of tax by salary packaging. And instead of paying tax, you're actually just paying your HEX. With most of my clients, as long as they understand, that I'm actually only paying back my HEX, I'm not actually paying more tax, that will actually make them feel better, I guess, at least they're reducing something, So even if you're going on your rotation, you're changing hospitals, as long as you know that at the end of the day, you have a HEX payment to make when you lodge your tax return and don't spend every dollar, then I think salary packaging really works as a good tool for tax savings. And okay, so this example really was when you're on, no rule rotation versus rule rotation. So if you look at here, when you go on your rule rotation, if you're allowed to salary package more than once, you get to package 11,650 times 2. That brings it up to 23. So your taxable income will be only about 66 as compared to the 78 when you didn't have a rule rotation. But so which means you're actually going to be paying a lot less tax as compared to here. But at the same time, as I said, the salary packaging will be 21,999. The reportable fringe benefit will be 21,999 per 11,650 that salary package. So because you package twice, that 21,999 will be multiplied by 2. So now it's up to 43,998. That brings your HECS repayment up to 110698. And on 110698, your repayment will be up at 8%. So at 8%, that comes up to 8856. But remember how I said, the employers will take out tax for HECS based on taxable income. So they will only be taking out tax of $2,300. So when you lodge your tax return, you actually have to foot a bill of $6,500. So that figure does grow quite significantly. But as I said, as long as you know that you've got a HECS debt to pay at the end and not spend every dollar, which you shouldn't be anyway, because you shouldn't be spending every dollar that you've got. So you shouldn't have a problem, with paying that. And also, when you've got a tax agent, you do actually get a tax deferral or tax lodgement deferral. If you're doing it yourself, obviously, your tax due date is 31st of October. But when you've got a tax agent, you do get a deferral of lodgement till May of the following year. So which means it buys you time to either save up the money or, keep the money in your bank account or investing it or whatever, my philosophy really is the money is better to be in my pocket as compared to the tax office. So I rather have the money in my pocket for a longer period. So having a tax agent will allow you to have that flexibility of having that money in your pocket for extra, say, 8 months or 10 months. So I guess plan ahead if you know that you're going to have this shortfall and work out and see whether, you've saved that money aside or whether it's worthwhile talking to an advisor. How should you get to pay this figure at the end? Okay, any other questions?
Another one just came through. So when do they take out your HECS, and do they take it out before they pay you your fortnightly pay?
Okay. Coming back here. So your HECS will be taken out here. So this is how really you'll be paid really. So this is your fortnightly salary. This is payroll, your hospital. They'll take out tax. If you're salary packaging, they will also set aside a portion that you want to package. Under this amount of tax here will cover HECS repayment as well. But this amount of tax that they take out for HECS will not reduce your HECS debt immediately. It will actually sit with the ATO until you lodge your tax return. So you may have thought, throughout the year of work, I've paid, $5,000 of HECS repayment. That $5,000 of HECS repayment actually only is still sitting with the tax office in their account until you actually lodge your tax return. Once you lodge your tax return, based on your income of the year, we work out what the HECS repayment income is, and that's how then that's when we can work out what your compulsory HECS repayment is. And if there's a shortfall of HECS repayment, you've got to top up. And if there's if they've taken out too much, then you get a refund of your HECS repayment. But just bear in mind that the HECS repayment will not be made until your tax return is actually lodged. Because clients, I've got many clients who've asked me this question before. They log into their MyGov account and they can see the HECS repayment never changed throughout the year. Taxes be taken out by the employer, but their HECS debt still remain the same. The reason is because they haven't lodged the tax return. As soon as you lodge your tax return, that amount will go down based on what your tax return says. Okay, any other questions?
That's it, Sherry. You've answered them all. Actually, sorry. One's just come through. So is that the same as income tax then? Yeah, HECS repayments in your fortnightly pay?
Yes, that's the same. So that's why, tax return really is a reconciliation of your income and expenses in the year. So all these tax are being put aside with the tax office, but it will only be paid or, I guess, once you lodge your tax return, because remember when, if you don't submit a tax return, the ATO has no idea what you've earned in the year in total, because you could have, salary income from multiple hospitals, you could have investment income, rental property, you could be attending, lots of courses, paying for all these deductions. So that will actually affect how much tax that you have to pay. So they wouldn't know what your tax position is until you submit that document. So that document is really important because it determines how much tax that you actually need to pay. I mean, ultimately, we just want to pay what we have to pay. We don't want to pay anything extra. And obviously, we don't want to underpay tax. But, as I said, when you have a tax advisor, always check with them and say, the hospital has taken out this much tax, is it too much? Is it too little? Because this is something that you need to factor in your budget. So you know that how much you can actually spend. And if you've set up goals for yourself, you want to know that you can achieve them quite easily and it works with your plan. Okay, any other questions?
I guess just another point to add is when you set up a goal, the first thing is obviously it has to be achievable. But I always let my clients know is that set up a goals, whether it be 12 months or 24 months, and always review it every the 3rd month, the 6th month, and the 9th month. Just don't let it be like after the 12th month, I'll look at it. Review it yourself, making sure and hold yourself accountable to make sure that you can achieve it by the end of your target period. That's another point to add.
Yeah, that's exactly right. Because budget is there, and it can change. Obviously, you need to kind of monitor yourself as well, because if you've, overspent this month, then you're not on track anymore. Then next month, you kind of just have to increase your savings so that you get back on track, because ultimately we have a goal that we want to achieve and we want to work towards that. So that's a really good point, anything else that you guys want to know or talk about? It doesn't have to be about salary packaging. If you've got any questions about what you need to do next year, whether it's tax return, or anything like that, happy for you to ask now.
Another one, Sherry, that's just come through is about salary packaging though. So what about extra contributions to super? Concessional is up to 25K. Is that salary package, or is it separate and in addition to the 9,000 that you can salary package?
Salary sacrifice into super?
Yeah, so extra contributions to super. Yeah.
Extra contribution to super? Okay. So the compulsory super guarantee is 9.5% by the employer. Your annual concessional cap is how much you can put into super that you can get a tax deduction for is $25,000. So that $25,000 is inclusive of the 9.5% by the employer. So this extra super that you put in is on top of the $9,000 that you're doing. So as long as you've got limit or cap that's allowable up to the 25,000, you can package the full amount through salary sacrifice. Does that answer the question?
Yeah, I think so. That's good. Thanks, Sherry.
Cool. Any other questions?
Sherry, can you just talk about the package that BBB offer our interns for their first year and what's included in that package?
Yep, sure. So our intern package is $330. It'll include, the preparation of your tax returns, working out your salary packaging plan, any general correspondence, emails, phone calls. If you need help setting up with anything or questions about tax return stuff, assistance with, insurance, if you need, to get income protection in place, buying a house, if you need help to get loans, and also, general financial planning advice. So that fee is not payable until we do your tax return next year. That's one thing. And also it is tax deductible. So it's not going to be so expensive after the tax deduction. Obviously, from my point of view, I would like clients to come and see us, at least have a chat first, so that you know what you're getting into next year before you actually start work. Because if you waited till January or February next year, you are actually you're really short on time because your first round of packaging ends in March. So don't wait till the last minute to come in, because that will not be beneficial to you. Okay, any other questions?
Yeah.
Are we all good?
Sherry, there's another one that's come out just about the first home buyer super saver scheme. So I don't know if you just want to touch on how that works.
Yep.
The question asks, do you have to live in it for 6 months or a period after from when you take it out?
Yes. So with the first home super saver scheme, that's a good question. So once you take out your money and buy your place, you do need to live in the property for at least 12 months. So with most of the first home buyers benefits, you do need to live in the property for at least 12 months after the property settles. So if you are thinking of using the scheme, come and have a chat with us because we will run through what you need to be aware of, how much are the caps. You've got your lifetime cap of the scheme, you've got your annual cap of the scheme, you've got the concessional cap of the scheme. And also, you need to know the timing of when you should put the money in, when you should take the money out, and how it will be taxed when the money comes out. And how soon or how quickly do you need to buy a house as soon as the money is out? That is also really important because you need to plan ahead to say, oh, I want to take the money out at least, a couple of months before you buy. Because remember, you need to take the money out before you sign a contract of purchase. So you need to work that out and say, when you should take the money out so that, the money is ready for you when you're ready to buy. I think it's once you've got the money out, you've got 12 months to 24 months to really buy your property. Because if you don't buy within that time frame, you have to return the money to the super fund. So there's a lot of mucking around. So you need to work out what's the best time for you to buy, and also when to put the money in and take the money out. And the scheme is actually really, a good thing for a lot of first home buyers. Remember, if you're already saving it, in your bank account, why not, consider using the scheme because you could, get a few $1,000s out of the scheme. So always, you come and have a chat with us and we'll go through all that with you. All right. Any other questions?
So just going back with the FXSSS, you mentioned that we have to live in for 12 months. How do we actually prove that?
Letters, your bills, your utilities, your voting area, so electoral. So all this will be, indication of how you can prove that you've actually moved in there.
Just another one, Sherry. It's with the FSSSS again. Can you only get the 30,000 from extra super contribution in excess of the 9.5%?
Can you repeat that question again?
For the FSSSS, can you only get the 30,000 from extra super contribution in excess of the 9.5%?
Yes. So, well, yes and no. That 30 grand can be part of the nine. Well, okay. If you want to get a tax deduction, yes, it will have to be the limit of that, extra bit over the 9.5%. If you don't want to get a tax deduction, you can put in extra on top of, whatever the 9.5% is. So what I'm trying to get at is the 9.5% will not be part of the 30 grand. That's number one. And number two, there are two options of putting that money in, either as concessional contributions or non-concessional contribution. If you wanted to, to go in as a concessional contribution where you get a tax deduction, then you have to factor in the 9.5% made by the employer. If the employer was doing 10 grand for you, the maximum you can top up is 15. If the employer was doing 20 grand for you, the maximum that you can top up for the year is 0, because the annual cap per year is, not 0, sorry, 5, because up to the cap is 25 and the extra that you can put in is 5. If it was non-concessional cap, then really you've got no restriction because you can do the 15 grand per year.
Cool. That sounds good, Sherry. I think we're probably right to maybe start wrapping up now. If anyone's got any other questions, they can shoot us through and we can still answer by typing through to you. But yeah, I think we might start wrapping up the webinar.
Sure. Any other? Okay, so I guess we'll just wrap up if there are no other questions, as Kelvin mentioned. So again, remember, just a really quick disclaimer. Remember what we discussed today are really in general terms. So it may or may not apply to you or your circumstances. If you have a very specific question or personal question that we've not answered today, book in, a time to come and see us. We will be, Kelvin, Anthony, and myself, and then we'll run through what you need to know next year. All the best for next year, and have a good Christmas and New Year. Thank you, guys. Bye-bye. Should I stop it?